Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio Strategy and Management. I've been in this business for many decades, and I learned something that I'd like to convey to you. Uh, the best way to say it is that, I used to be a tennis player, a good tennis player. I was number one amateur tennis player in Italy, and where I won the championships. But anyway, one of my best training was to hit a ball in a against the wall, and then slowly and steadily for hours just have the feeling that the ball would hit the racket and then would hit the wall and then would hit the racket, and I felt it. I could almost play with my closed eyes. Another example is, I don't know if you read the book, uh, the art Zen and the Art of Archery. And what this book says is talking about this gentleman who wants to learn how to hit the target with the arch, and he goes to a master, and eventually he could not do it, and the master would tell him what to do, but eventually he understood. And the only way he understood from the master that he had to become the game. Once he understood that he was the game and part of the game, then finally he hit the target. Something like this happens in investing. And what I would like to show you, one concept, and you might or might not apply, you might or might not like it, but I found it very useful to understand and just where the markets are going and why. Let me show you. I meet once a month with a group of people who want to talk investing and business cycles and so on. And one slide that I showed is this one, with all sorts of information: interest rates, gold, bonds, Federal Reserve, credit spreads, foreign markets. And I asked them, what does that mean? Let's talk about these indicators. And of course, as you start looking at all this detail, without having a framework, you get lost, and chances are you come with different conclusions because one indicator says something, another trend says something else. So, and the point was, if you don't have a framework, you cannot put all the information that is bombarding you every day, make sense out of it. So let me show you my framework. This is how the game is being played by the market. These are the rules of the game. You have everything, all the markets are moved by the economy, how the economy grows. It grows above average, slows down, below average, picks up again, and then start growing above average again. Business start growing here, improves when inventories are in line with sales. Businesses start making money again, so they start hiring, more income in the economy, and the economy expands. There is a point here, though, that interest rates and inflation start rising. And this is the problem when the problems start become more evident to business. Why? Because here now demand slows down because of rising inflation and rising interest rates. Business start building inventories, start overbuilding inventories, so earnings start slowing down. And so you have inflation, interest rates rising, business that beginning to correct inventories, meaning that now there is the beginning of the correcting phase of the business cycle. Then you have phase 4. This is where all the problems are being taken care of. And this means taking inflation, interest rates down, taking inventories to levels that finally here profitability becomes to improve again. When this happens, then the new business cycle goes underway. By the way, this was 2021, as I will show you later. During this phase here and here, growth stocks and what they call cyclical stocks, industrials, financials, commodities, are stronger than the market. During this period, instead, conservative defensive stocks are the best investment. And you will find probably in most 99.9% of the cases, the times also bonds are also very strong. So let's see now what kind of data. In fact, I will show you only one piece of information that you can follow and see how you can understand how the game is being played. Because you see, here started 2021. People get involved with all what happens, the Fed and not the Fed, but you know that the play has to come down here. You know, I have many articles written. By the way, you can read them on either Seeking Alpha or in my website. And so, from here to here usually is a year and a half to 2 years. So people get involved of what happens to the Fed, what happens to China or to Russia, but the business cycle keeps on going steadily until all the problems that have been created here have been taken care of. There are indicators to follow the pattern of the business cycle. These are the most important one as far as I'm concerned: the money supply, the yield curve, the stock market, and above all, the lagging indicators. These are the most important ones. The coincident indicators tell you what is happening, and the lagging indicators are the outcome of what has happened before. So inflation, interest rates, and costs depend on what has happened a year and a half earlier, depending on what has happened here. So let me show you how. This graph shows the growth of the money supply, and this is the growth of employment in manufacturing. The purpose of this chart is to show you the lead-lag relationship between the two indicators. And they are very useful because, again, it tells you how the game is going to be played. The money supply is a leading indicator because the growth of the money supply is followed after a year and a half by growth in employment in manufacturing. And the slowdown in the money supply is followed by a slowdown in employment after a year and a half. So what is the point? The point is that when you are at an inflection point here in employment, at this point, what you see here is the effect of what has happened in the previous year and a half. In other words, people worry what is happening, what is the layoffs and so on. No, this point has been set by what happened in a year, reflects what has happened a year and a half earlier. So when you're looking at this point, you're looking at the past. Let me put another interpretation of this. What's going to happen to employment? Well, if there is a year and a half lead of the money supply and employment, even if, assuming that the money supplies are picking up right now, it's going to take a year and a half for this curve to slow down before it turns up. So whatever decisions you're making, they're already set for the next year. You see how the game is. What you see now is history because it already happened, has been caused by actions taken during the previous year and a half. And what will happen next for the next year and a half is already set in stone, because even if this rises, the employment will keep on declining for a year and a half. Let me give you another example. Let me give you now another example of leading and lagging. This is the money supply, peaked in 2021, growth started declining ever since. This is the inflation, the red line. Notice how the money supply started increasing, and after a year and a half, probably 2 years, inflation started rising. The important point is that the peak in inflation is the outcome of a year and a half to 2 years of declining money supply. So it's not what happens to commodities yesterday or the day before or crude oil now. This peak has been caused by a decline in a leading indicator like the money supply for more than a year and a half. How do you apply that for your investments? Well, even if the money supplies start rising now, it takes at least a year and a half, possibly 2 years, before the inflation starts rising again. So already the future is set. There is nothing that can happen, minor details. But the main trend of inflation is down until 2024. So now you can set up your investment strategies. So you see how the game is played by understanding the future has to go only in one way. If you understand the relationship, if you captured the relationship between leads and lagging indicators, as I've been mentioning here. The relationship between leading and lagging indicator is very important because it allows you to, for instance, understand the risk that there is in the stock market. The stock market is a leading indicator. Interest rates are a lagging indicator, meaning that in general, a lagging indicator is cost, and leading indicator, let's say, is profits. When costs rise, then profitability slows down. When interest rates and inflation declines, costs decline, therefore earnings start picking up, and then the leading indicators like earnings improve. So there is a lead-lag relationship, which is very important, which has huge leads and lags. Let me show you how it applies for interest rates and stock prices. When interest rates, the lagging indicator rises, is followed by a period of poor stock market performance because earnings do not perform well. On the other hand, when the lagging indicator declines, the decline is followed after a year and a half by improving leading indicators. A rise in the lagging indicator cost is followed by roughly a year and a half by poor economic performance, poor earnings, and poor stock market. Here is the same thing. A rise in the lagging indicator is followed by a peak in the stock market, which means at this point you are basically in phase 3 and 4, if you remember the first slide. Here you're now in phase 4 and getting the stage for the economy to improve, and sure enough, after a year and a half of peak in interest rates, you have the leading indicators picking up again. So there is lead-lag effect between turning points in between leading and lagging. I will show you the next couple of charts, a little more formal way of looking at it. The purpose, of course, of all this is how to invest and to follow an investment strategy that reflects the economic times. This is the business cycle as we computed in real time from market data. This is the 2021 peak in the business cycle that I mentioned in the first slides. And this is the slowdown that started in 2021 until now, which is 2023, mid-2023. Actually, it's April 2023. So the investment strategy during this period is different from the investment strategy here. Here you invest in aggressive, high beta, industrials, financials, commodity kind of investments. Here is defensive, mostly utilities, healthcare, and staples, in 99.9% of the cases in long-term treasuries. So let's see what happened from 2021 to now to the 11 sectors of the S&P 500. This is the performance for mid-2021 to now of the 11 sectors of the S&P 500. Except for here, this is energy, which has been really due to the war in Ukraine, is an outlier. But if you look at the best performing stock for more than 2 years, this is April, being recorded in April 2023, the best performing sectors have been staples, utilities, and healthcare. History repeats itself amazingly. I wrote several articles on this subject how sectors behave in different parts of the business cycle. You can find them on Seeking Alpha or in my website. I store there. I've been writing it for many months because the game was set since 2021. You knew that the markets have to behave only in one way, and they are proving again this is how they keep on performing. There could be variations, but again, the direction is what it is. This is how the game is played. You have disregard the coincident indicator, which is really the economy. But the game is being played between the leading indicators and the lagging indicators. As I said before, the lagging indicators are the most important ones. Why? Because they reflect the excesses like interest rates, inflation, and costs that rise at the end of phase two. As soon as they rise and start going up, you know that you have to start switching strategy and looking at a more conservative investment strategy. Why? Because as lagging indicators rise, you know you're getting closer and closer to a peak in the leading indicators, which meaning earnings, stock market, money supply, and yield curve. Now the excesses are in full, rising sharply. The leading indicators now start declining. Why? Because they cannot rise until the excesses are being brought under control. In other words, business can only improve production only when they see that their profits start improving again. And this happens here when inflation and interest rates and costs have declined sharply. Only when they are down sharply, then earnings rise, and now you can invest aggressively in growth stocks and cyclical stocks, waiting for this curve to happen. Now, why the game is slow and you have to be patient? Because once this, again, this was 2021, it started coming down. We are still 2023 waiting for this curves to come down. So the game is slow. Once you understand this relationship between the leads and the laggings, then it's easy to understand the game. So for instance, now the stock market for 2 years has not done anything, but interest rates really have not peaked. So this curve will have to keep on going for a long time until inflation and interest rates really come down in a major way, until earnings start improving, accelerating again. So you see the game is slow. Once you have it, once you own it, then you can develop a defensive strategy or an aggressive strategy. As I said, I'm the editor of the Peter Dack Portfolio Strategy and Management. You can have a free subscriptions by going www.peterdack.com. You can read my articles and see by yourself what I said since the last couple of years, what the trends were. McGraw-Hill Education asked me to write this book, which I did, and it's now available on Amazon, and is also available in many different languages in Asia. I also wrote 2 more other books. This is a study on moving averages and how you can use moving averages to set up model portfolios. And this is sort of a recap of everything I learned in very simple terms. Well, thank you for reviewing this video, and hopefully the concept that I discussed is relevant will be relevant to your investment strategy. Again, thank you very much, and hope to see you really soon. And don't forget to check my website, www.peterdack.com. So long, everybody.